Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
If voting changed anything, they'd make it illegal. Emma Goldman, Committee, a group of the unwilling, picked from the unfit, to do the unnecessary. There are three kinds of lies, damned lies, and statistics. If you torture the data long enough, it will confess to anything. It is difficult to get a man to understand something when his salary depends upon his not understanding it.
This is not a trade map, it's a leverage map. The US gets roughly 14% of its goods imports from China. Japan is about 22%, Australia 25%, Brazil nearly 25%, Cambodia close to half. That's not diversification, that's dependency. Supply chains don't relocate on political speeches. They relocate over decades with capital, infrastructure, and ecosystems. Electronics, machineries, intermediaries. These aren't plug-and-play swaps. So when tariffs rise or export controls tighten, the shock isn't theoretical. It hits inventories, prices, and negotiating tables. The world just added $29 trillion in 1 year. Total global debt now sits at a record $348 trillion. That's not stimulus, that's structural spending. Governments are borrowing for defense, supply chain security, energy transition, and industrial policy. The debt to GDP ratio has cooled from pandemic peaks, but the absolute pile keeps growing. Here's the shift. Borrowing is no longer counter-cyclical, it's strategic. Higher debt means higher refinancing risk, tighter fiscal space, and markets that suddenly care about bond vigilantes again. Tariffs were sold as a cure. The trade deficit didn't get the memo. 2024, a minus $1.215 trillion deficit in goods. 2025, minus $1.241 trillion. That's a 2% increase and another record. Here's the issue. Tariffs can shift suppliers, but they don't magically shrink demand. The US still consumes more goods than it produces. So imports reroute, prices adjust, and the gap remains. Trade balances reflect savings and investment dynamics and not just customs policy. Outward remittances under the LRS scheme slipped 4% in FY26 so far, down to about $21 billion. That's the first real cooling after years of surge. But look beneath the headline. Overseas property purchases are up 77%. Equity and debt investments are up nearly 59%. Meanwhile, spending on studies abroad is down 22%. Travel is down. Medical payments down sharply. Translation, this isn't just cyclical pressure, it's compositional change. Households are reallocating from consumption abroad to asset accumulation abroad. The surge is over. Indian student additions to the US fell nearly 50% in 2025, down to about 31,000 net additions. After the post-pandemic rush, higher costs and tighter visa scrutiny are cooling the pipeline. But here's the twist. OPT numbers exploded, up over 5,000% since 2023. That means fewer fresh enrollments, more students staying back to work. And course preference, math and computer science now dominate at over 43%. This isn't wanderlust, it's labor market strategy. Education flows mirror opportunity cycles. When policy tightens, behavior adapts. India has about 34 cars per 1,000 people, among the lowest globally. Come to two-wheelers, around 185 per 1,000. That's not a preference, that's economics meeting infrastructure. Advanced economies scale on cars, emerging markets split. Brazil and South Africa lean towards four-wheelers, India and Sri Lanka lean towards two. Affordability, traffic density, and urban design shape the mix. At the household level, over half of Indian families own a motorcycle or a scooter. Fewer than 1 in 10 own a car. The macro takeaway, as incomes rise, auto demand isn't if, it's when, and in what format.